Evan Bradley. I am the Chief Financial Officer for Campbell Property Management. I am one of the 5 partners of the company, and I also am a licensed CAM, and I work very closely with some of our largest association clients on the major issues facing their associations. For those of you who may not be as familiar with Campbell, we are 100% locally owned and operated and have been in business since 1953. We manage over 400 HOA and condominium association clients in Dade, Broward, Palm Beach, Martin, and St. Lucie counties exclusively here in South Florida. We pride ourselves on our reputation as the highest rated property management firm in the area. Our focus is on continuity, peace of mind, and customized solutions for our association clients. Our special guest today is one of the premier auditors in our industry. It is Nicole Johnson of Hafer Certified Accountants. Hafer services many Campbell clients with their auditing and tax return needs. So Nicole, would you like to introduce yourself and the firm today?
Sure. Thank you so much. I appreciate your time today. Thanks, Evan, and thanks, Ashley. It's a privilege to be here with Campbell. I appreciate it. They really work hands-on with all the external auditors and the reporting systems, be able to get us everything. Exceptional job too. So I appreciate today to be honored to doing this class. We specialize in the area of HOAs, condominiums, developer turnovers. We are a full service CPA firm that basically does most association work. It's not all of our work that we do, but it's a majority. We also do a lot of budgeting help, consulting on the tax side, anything that involves associations. We ask our clients, or even if you're not a client, to reach out. We're more than happy to help any of our associations. So today is going to be a fun and interesting class all about auditing. So not that it's that exciting, but especially when you get into the nitty gritty of it, but I'm going to try to make it as exciting as possible. I know that if there's questions that pop up and we do have time, Evan, you can interrupt and you can give questions throughout the presentation. I'm fine with that. I will make sure that we only go an hour. I will respect your time. I know that everybody is so busy in today's day and age, especially this time of year. So as you're all aware of, it's almost April 15th. Make sure that you're ready for your association, that they've had their taxes filed or that they filed an extension, and make sure that you know that you are a tax organization with the IRS. I have many clients that call me and say, well, we're a not-for-profit. We don't file taxes. Yes, you do. Every association files taxes. You're a not-for-profit in the state of Florida, but you are a profit organization under the IRS. So today is year-end external reporting and what you can expect in an audit. So let's start with some fun things, some jokes. Accountants are so funny. So how did the auditor propose to his girlfriend? With an engagement letter. So an engagement letter is required in an audit, which we will talk about in the presentation. The first step of an audit is always making sure that you engage the actual CPA firm. Make sure that you have it signed. One of the most crucial things to start an audit process, even a review or a compilation, is making sure that engagement letter is signed. We always recommend that you have it signed before year end, even a few months before year end. Perfect timing is budget time. When you're working on your budget, is making sure that when you have all of your contracts, you're looking at your management companies, you're looking at your landscaping, make sure that you have your auditor signed for year end, because most of the auditing firms are doing planning. They do most of their audit planning in October, November, and December. And if you're not on their list, there's a chance that you're not going to have it in a timely fashion. Why are, can't see the whole screen. Let me move this up. Okay. Why are accountants so calm, composed, and methodical? They have strong internal controls. So a key aspect of auditing is internal controls. So when an auditor is coming in to do your audits at year end, they are evaluating those internal controls. They are not auditing the internal controls, they're evaluating them. There's a difference. They're not going in and testing every internal control. They're doing possibly walkthroughs. They're interviewing the management company. They're interviewing the board of directors. They're doing things to get it like a comfort level on those internal controls. And then they're issuing at the end of the audit a report giving you recommendations. One of the things I always tell my board members is that internal control letter at the end, the AU 265, is to help you as an organization. Don't take it as a negative, take it as a positive. We're giving you ideas on how to improve the association. I'll have some board members that embrace it and they say they're great ideas, we should do this. Other ones take it as a negative and say, We don't want that on the letter. Well, if there's a weakness, we need to make you aware of it. That helps to get your internal controls in better order. So I always say, embrace that and meet with your auditors and say, what can we do to be better? Let's go to the next slide. No, it's not working. Sorry, it's saying I'm paused. Let me see. Technology at its greatest.
Mhm.
I don't know why it's not letting me go to the next screen.
Well, one thing,
Sorry,
Nicole,
everybody.
while you're working on that, just one thing I'll say
Yeah.
about internal controls, and you'll probably get to it, is the separation of duties concept. It's very, and I know you'll touch on that, but it's very important that you don't have just one person who has control over everything going on inside your association when it comes to financials.
Exactly. It's crucial. I apologize, everybody. Sometimes technology gets the best of us. I totally agree with you, Evan, is that you really have to be, internal controls are what are making a strong financial reporting too, because those controls are also a part of financial reporting, which I'm going to talk about. Accounting joke. What do you call a trial balance that doesn't balance? A late night. So we have a lot of those late nights, especially sometimes in these self-managed communities. We'll get a general ledger, we'll get a balance sheet and income statement, and they don't tie out. And it's a problem when we're doing the audit, a major problem. What is internal control in an audit? So very crucial to starting an audit process is understanding the internal controls from an audit standpoint. We are required as outside firms to get an understanding of it. So a process within an organization designed to provide reasonable assurance. And why I stress that word, reasonable assurance. Nothing you do in any audit is absolute assurance. And it is key to know that as a board member, property manager, nothing is going to be ever absolute. It's always, is it reasonable what they're doing, and that reasonable assurance. That information is reliable, accurate, and timely. Are you getting your financial statements on a timely basis? I was doing an audit and I was interviewing the board, and I said, are you getting your information timely? They said, we usually get our financial reports, 4 or 5 months after. That's a problem. How are you making good financial decisions when you're not getting your financial report on a timely basis? So that is very important. And are they reliable and accurate? Compliance with policies, plans, procedures, laws, and regulations. Very important in every association, regardless of your 718, 719, or 720. That's condo, co-op, and homeowners association. Are you abiding by the statutes? A part of an audit process at year end is a compliance audit. You are a part of that statute and making sure that you're abiding by the statutes. Is your budget in compliance? Is your pooling schedule in compliance? Are you having the budget meetings timely? Are you approving it before year end? These are the things the auditors are looking at and making sure you're in compliance. One of the hot topics in the last couple of years is the pooling method. A lot of associations have been deficient in their pooling schedule. And it's been a problem because it's been addressed in the audits that they're not doing that pooling schedule accurately. Assets, including people, are safeguarded. Your employees, do you have golf carts? Do you have assets that need to be protected? Your gym equipment, is there a tracking of that from an internal control standpoint? Board members will say to us, why do we have to track that? If you have 5 golf carts and all of a sudden we come in next year and you have 4, where is the other one? Things can easily disappear. Make sure you're tracking those assets. The most economical and efficient use of resources. So a lot of times you'll see in internal controls that we bring up as the outside auditors, segregation of duties. And that's a big point in internal controls. The auditor is not telling you to go out and hire accounts receivable, accounts payable, a general ledger, especially if you're self-managed. But what we're trying to say is it still can be accomplished, segregation of duties, without hiring all those people. If you have an outside management company, you're going to automatically have those segregation of duties built in with their contract. There's going to be a lot of oversight. They have somebody overseeing, reconciling the bank, accounts payable, accounts receivable, which you're getting that as a part of their management, which is crucial to good internal controls, especially this day and age. There's a lot going on with fraudulent activity, misappropriation of funds. When you have that oversight by an outside company, you have less likely that will happen. Overall, establish objectives and goals are met. What are the goals of the association? To make sure you're managing other people's money. And I say that very strongly because as a board member, you are managing millions of dollars of other people's money. It's almost like you're like how these financial advisors work. They're managing your money. You're managing these people's money. And it's crucial that you're doing all the controls in place to make sure that you are safeguarding those assets. Intended to prevent errors or irregularities, identify problems, and ensure that corrective action is taken. Making sure that if errors do happen, how do we prevent that in the future? Are we looking at those financials on a monthly basis, those budgets versus actuals, and making sure we're addressing that we need to correct it if something needs to be coded differently, but really reviewing those from an internal control standpoint and evaluating the internal controls on a timely basis. If you see things that are being done incorrectly, where's the problem? For example, something's coded incorrectly. What happened? Was it that the board didn't realize it should have been an operating versus reserve? Okay, that's not really an internal control issue. Is it that people weren't paying attention to where it was coded to? That could be a problem. So there are the things that you evaluate on a monthly basis. The internal control mystique. Internal control starts with a strong set of policies and procedures. Internal control starts with a strong control environment. I always use this word and I go back to accounting in college, tone at the top. It's crucial in internal controls. What is the tone at the top of the board members that trickles down to the employees? Is it, we want good, strong controls. We want good financial reporting. We don't do things that are not in compliance with statutes and with accounting practices. That is called tone at the top. So everybody feels that you want to do things on an ethical basis. Internal control, that's why we have internal auditors. Management is the owner of internal controls. And when I say management, board of directors. Board of directors are ultimately responsible. Even if you're hiring an outside company to do your financials, to do your management, the ultimate person responsible is the board of directors. Even with your records, and I want to be strong on that, even if you hire an outside management company, the board of directors are still responsible for all of their records, all of their financials, because it ultimately is the association's records. Internal controls cannot ensure success. Even if you have everything in place and you're doing everything you should be in accordance with internal controls, good policies and procedures, there's always issues that can arise. Bad decisions. There can be bad decisions on behalf of the board of directors. That cannot help with internal controls. Somebody making a bad decision. Poor managers, a manager not understanding the statutes or understanding how things should be run, not having a good business background can be an issue with success in internal controls. Unethical behavior. That is something you cannot prevent no matter what you put in place. Somebody that's either on a board or a manager that doesn't have ethical behavior, that is going to not ensure success at all from an internal control standpoint. Collusion. One of the hardest things to uncover in an audited financial statement is collusion. Collusion is two people basically in cahoots together, that they're doing things fraudulently with each other. So maybe a board president and treasurer, they know what they're doing, they're signing the checks, they're allowing it to go on. One of the hardest things to uncover. Same thing with kickbacks. So a vendor is good friends with a president and decides that he's going to do work on the property, they approve it, and he's potentially getting services from this vendor at his home. How do you uncover that? Very difficult in an audit perspective unless somebody comes forward like a vendor and says, yes, we're doing work to their property, we're doing this. Very hard to uncover. The most important thing is that you as a board for internal controls are voting a vendor at a meeting, and it's being transparent to the owners, and it's not just one person approving a contract. So they're the kind of things that internal control wise you can put in place to try to prevent that from happening. An override of controls. So I've seen this many times in associations where there's an overriding of controls. For example, they hire a management company, great management company, they're following the procedures, let's say of Campbell, everything's running smoothly, and the board president says, we need a checkbook on site because if a vendor comes here, I want to pay them. Well, that's overriding controls. Everything should be going through Campbell's internal controls. The vendor can wait 30 days to get paid, or you shouldn't be using a vendor that needs a check immediately on site. There shouldn't be circumventing of controls. That's when there's a problem for internal control success. Who's responsible? Ultimate responsibility for your financials and in an audit, and that's why auditors interview the board of directors. Ultimately, they are in charge of signing the contracts, approving the vendors that are coming on. Your management, which is under that, which is your management company or your property manager, they take direction from the board of directors. So it's interesting, we'll do an audit, we'll do the interview, and a board will say to us, oh no, that was the property manager's decision. No, that was the board of directors' decision. The manager doesn't make those decisions, and they wouldn't want to. They wouldn't want their license on the line because they are taking direction from the board. And then your personnel is last. So your employees ultimately do not make decisions. They're taking direction from the board of directors. Responsibility of internal controls. I can't emphasize this enough. Board of directors, ultimately responsible. Management is primarily responsible. And then the independent auditors at the end are gaining an understanding of the internal controls to the extent of their audit procedures. They are not responsible for your internal controls. So a lot of times when you come in to do an audit, they'll say, well, you're the auditor, you're going to find all that. Our job is to audit you, to audit that you're doing it correctly, and then give you a report, an opinion on the financial statements. Do we believe they're materially correct? And then giving you an internal control letter of recommendations. But we're not implementing anything. And there's a big misunderstanding in the audit perspective that the auditors are doing that. The auditors are making the decisions. The auditors cannot make decisions on behalf of the association. And the number one reason why, they must be independent. Independence is crucial in an auditing firm doing an association. They cannot have any connection with board members. They can't own in the association. They must have an independence so they can issue an opinion at the end of the audit. Control activities, do's and don'ts. So in an internal control perspective, the do's and don'ts, your approvals. Board of directors should be the ones that are, eventually approving, looking at those invoices and signing checks, that they're overseeing that. The board of directors are authorizing. By signing those checks, they're authorizing that those invoices took place, that they're approving it. In an audit process, we are going through each of these and we are evaluating these from an internal control standpoint, and then we're also testing them. So when a board member tells us, yes, there's 2 signatures on every check, we're going through and testing those checks. Are there 2 signatures, what they're telling us? We're also looking at invoices and tracing them back to the GL. Are they coded into the general ledger? Are they have proper approvals on them? If not, we're giving you an internal control letter saying, these are the weaknesses. It was interesting. I use this as a story all the time. I was many, many years ago on site prior to pandemic when everything was on site and everything was in boxes, and we were doing the walkthroughs. And in association, I was interviewing the property manager and the board, and we were saying, do you collect cash? We never collect cash. Our policy is no collecting of cash. A unit owner walks through the door and pays his maintenance fees in cash while I'm sitting right there. So major internal control issue as I'm sitting at the audited, doing the audit report. So we verify those. We're looking at that. That incident, it just happened, but we're trying to do things to test those to get an understanding of that. Reconciliations. Is there segregation of duties in those reconciliations? Somebody that's actually bringing in the checks, recording them. Are they also reconciling the banks? Are they also a signer on the accounts? Security of the assets. Who's tracking all the assets and who's disposing of them? So if you have a golf cart and one gets sold, who's disposing of that on the financial statements separate than the person that's actually approving that sale? Performance reviews. Are you giving performance reviews to your employees? That is good business practice from an internal control standpoint. And then information system controls. Today, that is crucial in an audit, is your IT, is how are things being done, especially with electronic signatures. Do the management companies have the oversight, the firewalls, things that are being, how is the passwords? Is it only given to the board member? Can those board members give those out? So there's a lot of things with technology today that has really stepped up from the auditing perspective for us to get comfortable. I know when electronic signatures first came out, auditors, absolutely not. How are we going to handle this? We want these signatures on the checks. Well, if you don't keep up with technology, you can't keep up with what's going on in the world. So most firms got used to that and got an understanding of how things are being done and got comfortable with those. Now there's other systems like, for example, associations use QuickBooks. QuickBooks, we have a love-hate relationship with. QuickBooks is really geared towards small businesses. They allow you to delete checks. Nobody that built that system was definitely an auditor because we don't want to be able to delete checks. So there's some systems that have better controls. Key issues for associations: segregation of duties, lack of resources. So if you're an association that, says we want to do everything in-house, you have a lack of resources to have those internal controls through an audit process. The trust environment, the people that you have in your association working for you, do you have that trust factor that they are following those internal controls? Addition of new responsibilities and technical knowledge and knowledge of internal controls. Specific internal controls that I want to speak about. And as you're seeing through this presentation, internal controls is a very key aspect to auditing, is getting an understanding of all this so you can do your work when you get an understanding of this. 2 signatures on checks. It should be definitely, even if it's an electronic signature, you should have that oversight. No rubber stamps. So back in the day, we used to go in the offices and they had those stamps with people's signatures on them. In today's world, that should no longer exist. It's scary that it even is out there. Questioning unusual items. No blank checks to sign. I have associations, old school, that sign checks blank and leave them in the office for the summer. Not a good decision. First of all, somebody breaks into your office, they have your signature and they have blank checks for the association. That is not a good internal control. Limits to authority, that the property manager has authority to do certain things, but the board is the ultimate authority. Supporting documentation on all invoices. When an auditor comes in, they're going to test your invoices. They're not going to tell you the ones they're going to do. They're going to go through the GL and they're going to test them. They should have access to all the supporting documentation from any activity in your financial statements. Staff members should prepare journal entries. Then a supervisor should approve them and post them. Segregation of duties. Staff member who is in receipt of the money does not also account for it if money is coming in cash, or like, for example, your laundry machines. Is there segregation of duties if you're collecting coins? Monies that are received over the counter or through the mail are taken to the bank by a courier or a different person than the person who opened it. In today's technology, there shouldn't even be checks coming to the office. It should be literally through ACH or electronic. So now you've taken away that segregation of duty, and now it's out of the hands of somebody that has the authority to oversee that. 2 staff members should be involved in wire transfers. Wire transfers should always be approved by the board. There should never be not an approval that the board members know there's wire transfers. Payroll. If you're in-house and you have payroll, always segregation of payroll. There should be somebody that's approving the time cards and then somebody that's entering it. And then the board should be reviewing those payrolls on a monthly basis. The reason I stress that is that's one of the high areas of fraud is payroll. Ghost employees, people that aren't on the payroll that they're paying these employees, but actually the payment is actually going to somebody else in the association. And do not accept cash. Audit process. So now we got you into the whole understanding of how the beginning of the audit process works. That is us getting an understanding of your association. When we do those interviews, we do those walkthroughs, we get an understanding of everything we just talked about. Now we build our audit program to say what we need to do in this association because we have concerns based on the internal controls. So they don't have segregation of duties. They don't have an oversight of a management company. They have a lot of risk. So now your audit procedures are much more detailed because there's a lot of risk involved. Audit process is unique. And the main reason I say it's unique, auditing is a gut feeling. You're going in as an auditor, you're doing your work papers, but you as an auditor getting a feeling. Not every firm's work papers are exactly the same. That's why I say it's unique. My firm versus another firm, we may have completely different work papers. The concept and the documentation and how things are to be recorded are in accordance with auditing standards, but things that we test, things that we look at might be different firm to firm. They're not all the same. What they think is risk might not be something that another firm thinks is risk. Although every audit process is unique, the audit process is similar for most engagements, normally consists of 4 stages. Your planning, sometimes called your survey or preliminary review. It's basically your preliminary understanding. Where are the risk areas? What are things we need to do? Discussing with each other in the firm of high risk areas that we need to look at from an audit perspective. Then it's the field work. It's getting the actual list of items you need, bank statements, contracts, invoices, forms that have to be signed. Legal, are you sending out a legal confirmation to the attorneys? Getting third-party confirmations if needed. Then it's the audit report, which is most of you see is the draft. It's the draft of those financial statements, and then the follow-up review. If there's questions, if you have a closing meeting, client involvement is crucial at every stage of the audit process. Why? Because they are the ones that are going to give an understanding to the auditors of the risk, what goes on in the association. That's why in every audit we do as a firm, we interview the board. We have to interview. If the board members say to us, you really need to interview us, you get, yes. If they refuse to do an interview, we wouldn't continue with the engagement. We would have concerns from a risk standpoint. Why do they not want to answer the questions on an audit? Understanding the financial statements, the audit process. What is the purpose of the financial statements? The object of the financial statements is to provide information about the financial position, performance, and changes in the financial position of an association that is useful to make a wide range of users economic decisions. So the purpose of it is to give you financial statements, and I'm going to tell you what the auditor actually owns, to make sure you can make good decisions for next year's budget. Decisions on loans. Are we financially solvent to do a loan? Should we take out a loan? Where is our receivables? Are they good? Do we have bad debts? Do we have a bad equity position? What is our cash position at year end? These are all reasons to have good financial statements to be able to make financial decisions. The auditor only owns the opinion of the financial statements. The rest of the financial statements are owned by the association and the board of directors. So why I say that is, if you were auditing, this industry is very unique. When I moved down here, it was very unusual when I came into this aspect of auditing and realized that the auditing firms write the footnotes. So if you go into like publicly traded companies, they write their own footnotes. The auditors come in, they get a financial package, and they audit that. This industry, the board of directors, there's a lot of them that are on their volunteer boards. They don't have the background of the financials. So the auditing firms write the footnotes. However, those footnotes are the association's footnotes. When you sign off and approving them and you're signing off on the rep letter, you're approving that you own those financial statements. So that's why it's crucial as a board of directors to actually read the audit. Read the footnotes, because you have an understanding of what took place in the special assessments, insurance proceeds. You want to make sure those footnotes are accurate. And if the auditor is writing them, you need to make sure that everything they put in those footnotes agrees to what took place. Also, the purpose of a financial statement is for prospective investors and lenders to understand, are the financial statements viable? Do I want to invest in here? Do I want to buy in this association? Their receivables, they have over 100,000 in bad debt. They have negative equity and they're not funding the reserves. Do I want to buy in that association? These are crucial to people buying in there. And as we all know, Florida's a hot market right now, and people are asking for these year-end financials. Why? Because of the devastating Surfside. They saw what happened. They don't want to buy in a community where they're going to be in a situation where they're not financially solvent. Why the need for financial statements? First one, Florida statutes requires under 718 condominium, 719 cooperative, and 720 homeowners association are required to have year-end financial reporting. The question is, what are we to have? An audit, a review, or a compilation? And what are the differences? So under 718, 719, and 720, they're all the same under financial reporting. If your income is 150,000 or less, you are only required to do a cash disbursements, cash receipts report. It's basically a cash statement. It is not very informative. So most of your management companies are on accrual-based accounting. Their financial statements at year end are more informative than a cash disbursements, cash receipts report. It's basically cash in and cash out. So if you had a loan on the books or you had people that were delinquent, that would not show on the cash disbursement, cash receipts report. 150,000 to 300,000 is a compiled financial statement. In the statutes, it does not require a CPA firm to do the compiled financial statement. Most associations do hire an outside firm. The reason why is you are still required to have full disclosure in the footnotes. So it must still look like the report of the compiled financial statement by an outside CPA firm. 300,000 to 500,000 is a reviewed financial statement, and over 500,000 is an audit. That includes all revenues. So if you had a special assessment, if you had insurance proceeds, all of the revenue is what is the number comes from. So if you had maintenance fees of 450,000, but you had a special assessment of 100,000, your income that year would be 550,000, which would put you into the audit to require to have that. If your document states something different, you would need to speak to your attorneys on what you're required to have. There are some old documents in some associations we do that says they're required to have an audit, but their income level is only 200,000. So it would be something you would ask your attorneys what you're required to have. The difference is in reports. So your year-end reporting, a compiled financial statement is basically the outside firm is taking your financial statements, they're putting it on their letterhead, and they're doing minimal amounts of work. There's no assurance work like an audit. They're not giving you an opinion. It's a compiled financial statement. A review is basically analytical procedures. You're doing accounts payable testing. You're making sure that any checks that were issued out after year end are recorded in the proper period, but you're not doing any type of a test work. So you're not testing the invoices. You're not going in and doing internal control testing. You're not getting a report after the audit is done for the internal controls. You're getting a reviewed report. The audited financial statement, you're doing a test work. You're actually interviewing the board. You're doing the internal control testing. You're doing the testing of invoices, contracts. You're getting an in-depth, and then you are issuing an opinion at the end of it. And different types of opinions, but you are getting opinion at the financial year end. What are the requirements for Florida Statute 718 to have an audit, review, or compilation? So as I stated, the numbers, it's 150,000 to 300,000 for a compilation, 300,000 to 500,000 is the review, and over 500,000 is an audit. What is GAAP? Generally accepted accounting principles. It's funny, I was in a meeting and I used the word GAAP and someone said, isn't that a store in the mall? And I was like, it's GAAP, but it is generally, and it is required on a financial by an external auditor that you are in compliance with GAAP. Most of your management companies are on GAAP. It's kind of a hybrid GAAP. What I say by that is some of them do the accruals. Sometimes there's some accruals that are missed. That is common because when you get your financial reporting and you issue something in January to the auditors, January 31st, sometimes invoices come in February and March, and there has to be an accrual for that. As long as the auditors are not making a material change to the financial statements or an adjusting entry, they can still be able to issue an opinion on that financial. Review of the audit process. Obtain an understanding of the internal controls sufficient to plan the audit. You have to make sure that you have an understanding to be able to plan this audit. Determine the plan's level of control risk. Design and perform additional tests of controls. So most of your firms, they use certain programs to build their actual audit plan. What are we going to test? They customize their work papers in accordance with every audit. Every association is different. reassess the control risk, and modify planned testing. So when you go through the audit, you start and you say, I need to change a little bit of what my plan was because I see things that come up. I see areas of risk. Maybe after the interview, something came up that seemed unusual, and you have to go back and reevaluate your plan risk for that audit. Perform substantive tests and complete the audit, form the opinion, and issue the audit report. Types of opinions. So unmodified opinions, we're going to talk about the different levels. Hopefully most associations get an unmodified opinion, meaning a clean opinion that they have no concerns in the financial statements, no material misstatements, nothing to be concerned about, even if you have adjusting entries. Every association will have adjusting entries. Auditors will always find something to adjust. So I had a board talk to me the other day and they said, we wanted no adjusting entries. I said, I don't think I have any that do not have adjusting entries that are an audit. If they're a compilation, it can be very common, but in an audit perspective, you're usually going to have some adjusting entries. Standard unmodified opinion. Then there's also the unmodified opinion with explanatory language. So if there's some gap not consistently applied, part of the audits performed by other auditors, that's uncommon, but it can happen. Question concerning going concern. I actually haven't had any of these, but I have seen other auditors put that in there, a going concern. A going concern is the association going to be able to sustain? Are they going to be terminated? Are they going to have a receivership? There can be going concerns, especially back in 2008 and 2009, when we went through all of that with the accounts receivable, the foreclosures. There was more going concern then than today. With the new law coming into place, that could be coming because there are going to be some going concerns with some associations with how the law was last year regarding fully funding reserves, regarding the inspection reports. There might have that in the future. Emphasis of matter, and then justified departures from accounting principles. Conditions required for issuance of an unmodified report, basically a clean opinion. The financial statements are presented in conformity with GAAP and including adequate disclosures. So when we put the financial statements together and we give you the draft and you go through it as a board and you say, there's some footnotes in there we do not want. If they are material to the financials and they need to be in there and you want them removed, that's a problem. You always want more transparency. We always want to be as transparent as possible. If it's something that doesn't apply, for example, when the new leases came out and we started putting them in the footnotes because we wanted to let everybody know a new accounting standard was coming out. And there were boards that came to us and said, we absolutely have no leases. We don't want that disclosed in there. Well, if they have no leases and it's not going to affect them in the future, there's nothing wrong with taking that out. But if they're having, for example, they have FDIC exposure, hot topic right now with everything going on in banking, and they say, we don't want that in there because we don't want the owners to know we have exposure. Absolutely not. That cannot come out. That is a footnote that would be required because you need to be transparent to risks that are in the associations. What we suggest is, you know about it now. What are you doing in this year to correct that? And if you've corrected it prior to the audit being released, you could put a subsequent event in there and say, this is what we've done in the banking. To now in 2023, that has gone away. So there's ways to do that so you can be transparent, but add an additional footnote that you've actually corrected what's happened in the audit. The audit was performed in accordance with GAS, generally accepted auditing standards, and there was no significant scope limitations. A scope limitation is when an auditor is asking for documentation and they can't get it. It's a scope limitation. So for example, there's an invoice for $550,000 they did on a special assessment and no one has record of it. That's material to the financials. We would possibly say that's a scope limitation. Another scope limitation. At the end of an audit, you're required to sign a management representation letter. I have boards that take over and say, I'm not signing that. I wasn't on the board prior. Prior board says, I'm not signing that because I'm not on the board now. Nobody chooses to sign on behalf of the association. It's a scope limitation. We can't issue a clean opinion on that because you're not representing to us what is required in the audit process. So it is crucial. Other types of opinions, modified opinions, departure from GAAP. Is it materially misleading to the association? It's a departure from GAAP. It's a modified opinion. And then scope limitations. Are they materially misleading? A scope limitation would cause for other types of opinions. So another one is an adverse opinion. I have to say, in all my 19 years of being in auditing in this industry, I've never issued an adverse opinion, and I hope I never have to. So I probably would disengage. An adverse opinion is a very material departure from GAAP. It's a problem. It means your financial statements are wrong. So I don't know if I've ever seen one either issued. It's a problem. You never want an adverse opinion. A disclaimer of opinion, I've seen these issued in associations. We have issued them. The main reason that we've issued them or seen other associations issued is records. So we've had associations, I had one last year we did, and they went through 6 management companies in 1 year. Not a good decision on the board of directors. And when we came in to do the audit, they could not find any of the records we needed to do the audit. That's a problem. It's a disclaimer of opinion. That means the auditor cannot give you an opinion on the financials because the documentation they need to do testing on, they don't have the availability, so they can't issue an opinion. And we've seen it all too often that it happens, is records get lost, there's things that need to be kept. The association is required under statutes to keep their records. So it is a problem. Also, a lack of auditor independence. So most auditors, if they are not independent, would most likely disengage from the association. Instead of issuing a disclaimer, they most likely would not do that. What a lot of firms do is, and I know in our firm we do, is because we do get peer reviewed. That means that every 3 years we have somebody come in and audit our books, is I have all of my associates sign off on every new client we get that they're independent of them, that they have no issue when we're doing the audit, that they're independent of the association. So that makes us in the clear that we're able to do the audits. I'm going to give you an example now of the audit report. So this has changed in the last couple of years. So it's interesting. A lot of my boards that are ex-CPAs or decided to retire and they're no longer in it, they're like, what happened to that simple, nice 1-page audit report? That's gone away. It's gotten very much more detailed, a lot more disclosure. It's still a clean opinion. It's just there's more disclosures basically for the auditor in disclosing things to the association. So the first part, you're basically going to be able to see in the 3rd paragraph down is the basis for opinion. That's what you're looking for, is where is our opinion? That will tell you, do you have a clean opinion? Do you have a modified? Do you have a adverse or disclaimer of opinion? So that's basically where you're looking for it. And then the last page of the audit report, that now it's 2 pages long, is going through basically performing the audit in accordance with generally auditing standards. And it's giving you basically the disclosures that we're telling you what was performed and what the association is obligated for. I think it's very important for associations, especially board members, to understand what the auditor is doing. The risk of not being able to detect something. In the engagement letter, when you sign off on it, it does say in there, our responsibility is not there to find fraud. Now, there's a lot of auditors that do find fraud, but it's not their obligation to do that. So a lot of people have the misperception, an auditor is going in there to look for fraud. No, if you're getting a forensic audit and they're going line by line, that's a different story. So forensic auditors, yes, they're going in line by line. Now you're paying for that. If every certified audit was like a forensic audit, associations would probably never have their audits done. It'd be, $50,000 to $60,000 to go through everything. What is a balance sheet? A balance sheet, also known as a statement of financial position. I think it's one of the most important parts of your financial and from an audit perspective too. Anything that's on the balance sheet, the auditor wants documentation for. On the income statement, they're not looking at every invoice, but on the balance sheet, they want backup for all of those line items: cash, accounts receivable, prepaid expenses, accounts payable, your loans, if you have a loan on the books, all back up for that. So the balance sheet together with the income statement and cash flow make up the cornerstone of the association's financial statements. The 3 reports are making up that. And then assets equal liabilities plus your fund balance. So this means that assets, or the means used to operate the association, are balanced by the association's financial obligations. They always equal that. So assets equal your liabilities and your equity position. It's basically a snapshot of the association's financial position at a point in time. So what it means is, as of December 31st, what is our cash position at that point in time? You may go to the next day and that cash drops or significantly goes up. It's a point in time. It's not like your income statement. Your current assets. The current assets expand over 1 year or less, meaning they're easily converted into cash, which most associations all have current assets. Accounts receivable, cash, prepaid expenses. Your liabilities. Liabilities are basically, what do you owe? What are your obligations? Very important to people that are buying in as prospective investors, prospective owners, or getting a loan to the association. I know a lot of banks are absolutely asking to see these financial statements. Do you have debt on the books? Do you have any type of accounts payable that is significant that hasn't been paid out? A major contract that you signed to do the roof, but you have no special assessment associated with it. Do you have the funds to pay for that? It's the current position of those liabilities that are owed. And then the equity position is basically all of your income statement flows through to your equity position. When your income statement closes out at year end, your surplus or deficit flows to your equity. So if you have a positive equity position, that means you've had more surpluses than deficits. Those surpluses have carried over to your equity position. Very good in association to have equity position. You never want to have a negative equity. Why? Because that means you have not run your association in the positive. You've run more deficits and you're not doing your budget in accordance to match what expenses you have. You're running the deficits. So just an oversight, assets is your cash and cash equivalents, accounts receivable, allowance for bad debt, prepaid expenses, property and equipment, and deposits. Property and equipment, usually associations don't have much of this. They only capitalize tangible assets. Tangible assets are things that you can generate revenue from or sell for a gain or loss. So gym equipment might be one of them, golf carts, as I stated in the past, but real property is not recorded on associations' books. Your liabilities, your accounts payable, who you owe at the year end, and making sure that if you pay them in the year after, they're recorded as accounts payable. Prepaid maintenance fees. That's people that paid you, let's say in December, that are for January. That's not revenue. That's actually prepaid, and then it gets recognized in revenue in January. Part of the audit process is to make sure that revenue is recorded in the proper period. Refundable deposits. This is an area that many associations struggle with. They have a large amount of refundable deposits, but they have no schedule to back it up. It's a problem in the audit. You could actually get a disclaimer of opinion. We had an association that had over $200,000 in refundable deposits, but no schedule for it. It's a problem. You need backup. Where's that money going back to? We need to make sure that we have that as a part of the audit process. Deferred revenue and notes payable, making sure that you have a year-end balance for your notes payable. It was interesting because many associations got SBA loans, and the SBA, it's difficult to get a balance on those and get a report. So a lot of them are having difficulty getting those balances at year end. It's crucial to your financial statements to know that balance and know what they've applied to principal and interest, because it has to be recorded properly. Equity is the interest of the unit owners in assets after liabilities are paid. That's why equity is considered, are you financially solvent in the equity? What is an income statement? Income statement, also referred to as a profit and loss statement of financial performance. It's basically revenue, monies that you billed out to the owners, and your expenses. What is our bottom line? Did we have enough revenues that we were able to cover the expenses and have a potential surplus at year end? So I hear a lot of associations that'll say to us, we're not allowed to have anything. We're to break even at year end. I don't know where that comes from. I don't know where that is out there, that philosophy. There's nowhere that states that. For tax purposes, if you file an 1120H and you have surplus under an association, that's not taxable because that surplus just rolls over to year. So I always tell my associations, you actually want to try to have surpluses. You want to have a buildup of equity. buildup of cash, because if things come up, you have the ability to pay for it. You don't ever want to be in a break even or at year end have zero cash and zero equity. That's not a good financial position to be in. You want to have a good financial position with equity, cash, and reserves. The purpose of the income statement is to show managers and board members whether the association made or lost money during the period reported. And the income statement is always from your January to December, or if you have different fiscal year ends, it goes for the year, and it always is shown on that period. The important thing to remember about an income statement is that it represents a period of time, not a point in time, a period of time. So the 12 months and showing your gain or loss. What is a cash flow statement? So a cash flow statement is basically exactly what it states. It's cash flow. From the beginning of the year to the end of the year, the net cash change in your receivables, in your equity, in your note payable. It shows you cash in and cash out. I know it can be a very confusing statement, but it's a good picture to lenders and creditors. They like that cash flow statement because they say, do you have the ability to cover all of your expenses and your liabilities through the cash that you're collecting? So it is a key financial report to a lot of vendors, a lot of lenders, a lot of people. If you're getting a loan on your books, they want to see that cash flow statement. What are footnote disclosures? Most people don't think half of them don't read the footnotes. The footnotes are the most important. Does this give you a true picture of what happened in the association? Your footnotes tie back to your balance sheet, your income statement. They're all disclosures giving more information about your financial statements. Examples of footnote disclosures. Let's go through. We did say supplementary information. So supplementary information is basically, we do a schedule of budget versus actual. We think that's crucial to associations. Also, the schedule of future major repairs and replacements. That is reserves. That is required under statutes to be disclosed. Under 718, it's the reserve schedule, which is required to be done. Either you had a reserve study done or the board of directors did it, and it's required to be disclosed. From an HOA standpoint, 720, if you're not statutory reserves, it's not required. Some boards omit it. I think it is good to have to be transparent to the owners. If you are statutory reserves under HOA, it is required under the disclosure part. Concentration of credit risk. I think it's a very important disclosure. Are you exceeding balances? Are you over the 250,000? Very key footnote to your members of your association where you're at. Income taxes, also a required disclosure. We want to make sure that if you do have any taxable income and it is taxed and you had a tax liability, that it is shown in this area. Most associations do file an 1120H. Many of them do not pay tax, but there are situations where you will. Is there any litigation? So there is a letter that goes out to the attorneys. If you guys fill out a form and say, yes, we have litigation, the auditor goes through your general ledger and sees these bills, and there are a lot of bills to the attorney. They will send a letter to the attorney and ask about litigation because it is required to be footnoted. Special assessments, also required. What is the purpose of the assessment? What was the amount? What was the expenses? And is there any leftover money? This is important for owners to know. I think it's a very good required footnote. And then future major repairs and replacements. So you'll notice on some of your audits, especially HOA side, condo side, it's standard language that you have in there requiring under the reserve. Under 720, a lot of people will come back to us and say, why do you have in the footnote disclosure? It's in bold and capital. It's required by statutes. It's because you're voluntary reserves, board reserves, and it's a requirement by statute. It is required to be in bold and capital. So it's not the auditors trying to make a statement. It is required by statutes. AU 260, you'll notice this is something that you get at the end of the communication. It's those charged with governance. We basically tell you if we had any issues with management, we had any issues in the audit, we let you know that. And then the AU 265 letter, that is the internal control letter. As a result of Sarbanes-Oxley in 2002, auditors are required to provide assurance on internal controls for associations. This letter is required. even if there's no internal control issues. If you have no internal control issues, it'll just be a paragraph and basically say there's no issues. But it is required on every audit to be issued. So that's my presentation. I think I made it just right in time, which is great. I don't want to hold you guys up, but I don't know if there's any questions that we have or.
Yeah, I think we did have a few, Nicole.
Okay, perfect.
Should the internal controls letter be shared with homeowners?
So when we're doing the audit and it's issued to the board of directors, it is the communication with the board of directors and the auditor. So they go through that, they do the meeting. It does become a part of the official records of the association, but mailing it out with the audit, it's not required. The audit is what is required to go to the owners.
Right. I think you addressed this, but do Florida associations have to be on an accrual basis? I'll say yes, modified accrual. Is that fair?
Yes, that's correct. No cash basis.
Right. As a general rule, how much of the underlying information that goes into an audit is available for residents to see? I'm not sure I understand the question, but the entire general ledger, the income statement, the balance sheet, everything is public record of the association. So
right. And the audit report has the entire audit report has to go to the owners, not just the opinion.
Right. There's a couple here that are somewhat specific to the individual association, so I'll skip over those. Someone asked, what constitutes annual revenue? Is it just assessments or does it include any other sources?
It includes all revenues, so special assessments, reserves, maintenance fees, any other income. Yes, all of it.
Great. All right. The question always comes up, how much do audits cost? So can you give a broad range, I'll say, of just people have a ballpark idea of what audits typically cost?
So it's definitely a range. So I'm glad you said that. It can go from anywhere from 6,000 to 25 to 30,000. It all depends on your revenues, reserves. Every firm is different. If you really want to get an estimate, you reach out to 3 firms, which is great, and get an estimate of what your association could cost. But 6,000 and up is usually what the range is. And it can go much higher than that.
Great. All right. Well, I think at this point, we're right up against 1 o'clock. So I want to thank everybody for attending today. Nicole did a fantastic job. It is a lot of somewhat complicated and heavy accounting material, but it's important. Even as volunteers, you guys do still have responsibility for your association financials. And if you have any questions, about understanding those financials, don't hesitate to reach out to your auditor or your management company. Your management company should be able to help you understand those financials as well. So any other parting words today, Nicole?
Just, everybody, April 30th and April 15th this year. So get your stuff in so everybody can get their work done. And I appreciate Campbell. Thank you. You guys do a great job. We like working with you guys. You guys have good internal controls. Yeah.
Thank you, Nicole. That's high praise coming from you. So
Yeah.
Thank you all. Have a great
afternoon. Thank you, everybody. Have a great day.
Bye.